Hello everybody, I'm Jeppe Kirk Bonde. Welcome to this 2026 Q2 quarterly investor update. If you want to use this presentation for anything, please go ahead and read the disclaimer here at the bottom very carefully. So in this presentation, I'm going to go through my background, then my investment strategy, then what I have in my portfolio, and finally go through the many questions that I've received in advance. So firstly, one of the reasons that more than 25,000 people are copying my investments on eToro is that since I started in 2013, I've really beat all the benchmarks and also had a higher average return and better return to risk profile than any other big equity investors you could fairly compare with. Terry Smith, he started Fundsmith in 2014. I started in 2013, so that's a very like-for-like comparison. The comparison with Warren Buffett is a little bit more difficult because he was investing way before I started investing. And so his track record is in that way much more impressive. Then my background, as a child, my dad, he was a member of the European Parliament for 29 years and a leader of a political party. And so when I was growing up, I also thought that I wanted to be a politician, but then along the way, I thought that it was more interesting to work with companies. And then I did my university degree in finance, and I started work as a management consultant, advising some of the largest companies in the world, including tech companies and banks and aerospace and defense companies. And then as I was working as a consultant, I was making more money than I was spending. And so I wanted to invest my money. And then I compared all the different platforms in terms of how good is the mobile app, how good is the website, what are their fees like, what instruments are available, what is the security like of the platform, how is it developing over time. And I scored all the different platforms on these different factors and weighted how important the factors were, multiplied those up, and then in ranking all the companies, eToro came out as number one, and so I started investing on eToro. And then as my investments on eToro did very well, more and more people started copying me, initially mainly friends and family, and then more and more different people. And in 2018, I decided to quit my job as a management consultant to focus only on managing my money on eToro. And then 1 year later, I was then number one on the platform. And today I'm the second most copied on the platform. I don't do everything on my own. I have a great set of suppliers that help me with providing all the data and the IT tools that I need. I have a good network that help me, including my assistant and my network of experts. If I invest in something, I have to either myself be an expert or know someone who is, because otherwise I can't get to the interesting insights fast enough. And finally, I'll highlight my three favorite experts, which are my three brothers. One of them, he did his degree in computer science and worked a lot with AI and now works with AI regulation via Control AI. And one of them, he's an economist in the Danish Ministry of Finance, and he's built the biggest economics models we have in Denmark. And finally, the last brother, he is a CEO of a large marketing company. So if I have any questions or concerns in these areas, then they are my go-to guys. Then my strategy is based on some principles that have been there all along. I focus on macroeconomics. What kind of growth rates can we see in different pockets of the global capital markets? I focus on megatrends. So what are the big factors that can really change the world over the long term? For instance, trends that are growing by more than 10% per year for more than 10 years. Then I focus on fundamentals, analyzing companies very carefully to understand their products and services, their management team, their employees, their customers, their suppliers, their financial statements quarter by quarter going far back. And then all of that with an eye on understanding how can this company really perform in different scenarios in the future, how much money can they make, and based on that, how much would I really be willing to pay for this company today. And then there's a quote by Warren Buffett: price is what you pay, value is what you get. And I really subscribe to that. I value companies and then I invest in companies I think are worth a lot more than their price would indicate. Then I focus on the long term. There's a great quote by Benjamin Graham, the author of the book The Intelligent Investor, and he was also Warren Buffett's mentor. And he said that in the short term, the market is a voting machine, in the long term, a weighing machine. And that effectively means that in the short term, it can be important, that what some people think, other people think. But in the long term, if a company becomes very big and profitable, it'll also be nice to own a big part of that company. And I have to sort of the patience to wait around for the weighing and the sort of stomach to ignore the voting. Then I focus on risk management, diversifying carefully across many different industries, geographies, and business model, and diversifying across companies with different kind of risk characteristics. And then I do hedging. That means finding companies that are having an opposite reaction to a particular risk, such that when they're put together, you sort of neutralize that risk. So an example is if you have companies that need a lot of energy, but you also have companies that produce a lot of energy, then when taken together, you don't have to care too much about whether the energy price goes up or down, because whether it goes up or down, you're going to have a series of winners and losers in that bucket. Finally, I stress test my portfolio. So looking through many different scenarios and evaluating how my portfolio could perform in those different scenarios, and then ensuring that I have a composition of assets that can do well in many scenarios and won't do too poorly in even some of the quite bad scenarios. Then finally, I focus on keeping fees low. I pay the same fees that copyists pay. So if I keep my fees low, then copyists keep their fees low. And keeping the fees low is a great way to just squeeze a bit more profitability out of your portfolio. So I don't use any leverage, I don't do any shorting, and I don't do any day trading. Then there are some areas where I see extra interesting opportunities. I like companies with organic growth, companies that can sell more products or increase the price of their products by more than the prevailing inflation rates. I don't like it if companies are just growing through acquisitions. So sometimes you can read in an annual report that we grew the revenue by 4% this year. And yes, that's right. But actually, that's just because you acquired another company. The core business shrank by 2%. So what you've achieved is really not that impressive. Then I like companies that are resilient, that have sustainable competitive advantages, or if they don't have at least a route for how to get them. I like companies with strong balance sheets that can perform well across many scenarios, not just in a few good ones, and that ideally can protect me against certain scenarios where many other companies would potentially not be doing so well. Then I like companies that are profitable, because that's also sort of an indication that actually people like your products and are willing to pay properly for them. And I especially like it if companies are able to then take those profits they're making and reinvesting it into themselves to grow even faster over time. Then I like when a company has a new good strategy. It's not enough that they say they have a new strategy. I like to see some real action that prove they're serious about this strategy. So changing the name of the company, or launching a new product, buying another company, or selling a part of the business or something like that in line with the new strategy, that proves to me that this is really happening. And the reason it can be good to invest when a company has a new good strategy is that often you end up paying the price of the old strategy, but you get the value of the new strategy. And then I like the companies that make the best products and services, because often the companies with the best products, they do win in the long term. And if you're a smart shopper who can go out and buy the correct product because you understand, like, in this group of products, these and these are the important features and these are not important, and it's worth to pay more for this and not worth it for this. If you have that understanding of the products, then you also have a chance of understanding the companies that make those products. If you don't understand the products, you can't understand the companies either, and then it becomes quite hard to be a good investor. There's a classic example of failing at that, which was when the former CEO of Microsoft, Steve Ballmer, he held the first iPhone in his hand, and he said, "Oh, it doesn't have a keyboard. It's way too expensive. I'm very comfortable with our position." And he was, of course, proven wrong by the massive success of the iPhone. And that was an example of sitting with the blockbuster product in your hand and not being able to see that it's the blockbuster product. And many people have recently made the same mistake with Tesla and then with Nvidia, and are probably going to do it again with other products in the future. Then finally, I like companies that are mission driven, companies that can attract and motivate and retain the smartest people, that are inspired by this mission. And there's some companies where the smartest, most hardworking people, they just really want to go there to work, and so they gain a massive advantage from that. And there are other companies where even if they overpay to get these people, they can't get the very best ones, they'll get the next best ones. And if those actually arrive. After some time, they will leave because they ultimately prefer being other places. And if a company is in one end or the other of that spectrum, that might not show up in next quarter's results, but a few years down the line, it'll make a very big difference. Then most of my money by far is invested in stocks. And that makes good sense because stocks have historically been the best asset category. Now, property has also been quite okay. I don't think it's as great anymore as we're building more and populations are not growing by as much in total. And then there are individual areas where it's good and others where it's quite bad. Bonds have historically been okay. They are currently also okay, but not great. Ultimately, the interest rates we're getting now compared to the inflation rates are not great. Commodities have historically done next to nothing. In the past decades, they've been quite all right, and potentially they'll be better in the future than the sort of the long arch of history. Collectibles, many people love different types of collectibles. When you add them up over time, they've not been a great investment asset class, but having a little bit in that can make sense from a risk perspective and in some other ways as well. But I certainly wouldn't want to have a significant part of my portfolio invested in that. Finally, currencies have historically been terrible. I think they're currently terrible, and in the future they'll probably also be terrible. They'll just lose out to inflation. And if I have a lot of cash, I generally like to get it pushed to the left in this chart and ideally invested in some stocks. Then there are some big factors that drive the global economy in the long term. Firstly, I like to focus on split it into three realms: the physical, the social, and the technological. In the physical realm, it's important how many trees are in different countries, how much oil is in the ground, how much of the different metals are here and there, and then the demographics, what what are the demographics like in different places and how are they changing over time? The companies that have the right product for the right demographic segments in the right places, of course, have an advantage. Then the realm in which the most value can be created or destroyed the fastest is in the social realm. So when you have a US dollar bill or a stock or a bond or a deed to a property, these are all just words in our head, numbers on screens and pieces of paper. If we believe in these collectively, then they can help us trade with each other, to cooperate with each other, and create a lot of value. But if that trust in these systems stops, then a lot of value is quickly lost. And then why does something have value? It might be very obvious to most people why a house has value. I mean, it's very tangible. It's made of brick and mortar or concrete. You can touch it and feel it. But if nobody wanted to live in a house and nobody wanted to look at a house, then a house wouldn't have any value. And sometimes what we humans value changes over time. And if something's changing at a rapid pace, even if it's starting in a small part of society, if it can spread everywhere, then that can be the basis for some great investments. Finally, there's the technological realm. So most importantly here, the big technological revolutions. These drive macroeconomic growth for Earth over the long term. So going from the agricultural revolution to the industrial revolution to the internal combustion engine to electricity, and then getting the computer, the internet, and now we're living through the technological revolution of artificial intelligence. But besides the big technological revolutions, there's also just the day-to-day incremental innovation happening in the homes and in different businesses where you're just doing things slightly smarter and better over time, and that can also really add up. Then from those big factors driving the long-term global economic growth, we can zoom in on where the world economy is right now. So right now, the global growth is quite okay. It's not amazingly high, but it's quite okay. A little bit low in Europe, but generally quite okay. Unemployment rates are at a normal low level, slightly too high in the EU, but otherwise generally at a quite good level. Interest rates are at a moderate level, so they were negative during after the great financial crisis, and they've been higher in recent years, but they're at a quite moderate level, leaving central banks with a lot of wiggle room so that if some issue should happen, they are ready to respond. Inflation rates have come down quite a lot since the highs in the tail of the pandemic, but they haven't gotten all the way down to goals yet. And now we are seeing potentially higher inflation for longer from the closure of the Strait of Hormuz because of high energy prices that then spill over into other prices as well, potentially, and limit what central banks can do. And that's a negative, a risk for the world economy, but we're also coming from a position of significant strength. So there is a lot of firepower to handle a potential large issue. So in the sense that we have a risk of a large issue, but we are also ready to tackle a large issue. And that puts us in a pretty good spot. Then there are some mega trends that I've evaluated are extra interesting. So if a company is driving or riding on the wave of one or more of these megatrends, then it's more likely to be found in my portfolio. Firstly, I like the nice to haves. When we humans, we have it all, then we like to compete with each other and have fun and see who can be better at various games and who can have the better fashion. And there are some companies with great growth prospects and profitability in these industries. Then the nice to haves cannot stand on their own. If you don't have the need to haves, then the nice to haves fall away. That goes for a country, but it also goes for a portfolio. It's very risky to only have one of those things. In the need to haves, if you don't have security and you don't have energy, then you can't get these other nice things. And some of the companies that are key to providing us all the energy we will need and the security we will need are in the portfolio. Finally, there are the enablers and accelerators that help us do these other things faster, better, cheaper. Chief of these, the companies that I think will have the most profits from AI in the future, and the companies that will be delivering us the next generation of amazing devices we'll all be using. And then when you've identified, an industry or a group of companies that are interesting because of some megatrends, you can sort of get an overview of them by looking at the multiples. And so this is an example of doing that for the Magnificent Seven, seven of the largest US tech companies: Microsoft, Apple, Meta, Tesla, Nvidia, Alphabet, and Amazon. And if we look in the top left corner, we can see that all of them have quite good profit margins, except for Tesla. Nvidia is quite a bit ahead of even the others. In terms of, in the right side here, we can see the growth rate is also very good across the board, except for Tesla, and really incredible for Nvidia especially. Double-digit growth for everybody except Tesla. The two top charts, the higher the better, because they're about profitability and growth. But the two bottom charts, the lower the better, because they're really about price. So in the bottom left corner, we can see that for every dollar of profit that Microsoft has, we have to pay $22 when we invest. And for Tesla, we have to pay 300 and something. I've kept this at 100 because effectively it doesn't matter once you're above 100, whether you're at 100, 1,000, a million, or a trillion. It ultimately means that you're not having any profit compared to what the price is. And you'd only want to invest in a company like that if they can get much higher profits in the future than they have at the moment. Finally, at the bottom right corner, we can see that for every dollar of revenue that Microsoft has, we are paying $10. And that's quite fine. They're getting a lot of profit out of that revenue as well, and they're growing it quite finely. For Nvidia, we're paying more than twice as much compared to the revenue. But they're also getting even more profit out of every dollar of revenue, and they're growing it faster as well. So that kind of makes sense. For Amazon, we're only paying $4 for every dollar of revenue. That can seem quite cheap, but we're also getting a lot less profitability out of every dollar of revenue, and we're not growing it as fast either. So that's a good way to sort of get a view of the of different companies using the multiples. Then my work centers a lot around my financial models that I've built over a long time that then get fed a lot of data automatically from different data providers, and also fed with a lot of data that I've made myself, which is numerical but subjective. So how much do I like a company on a specific factor on a scale from 1 to 10? And all that data flows through my many calculations and ultimately provides me with my valuations. How much do I really think this company is worth, and how valuable is it compared to its current price, and how can it perform in different scenarios? And then I want to make a portfolio at all times that has the companies that are worth the much compared to the price put together in a risk sensible way. And then looking at that, I can make my decisions. Those decisions are most often research decisions. So, okay, there's a new factor. Some new companies are looking interesting. I should learn more about them, go into detail, learn everything there is about this new technology, about this new company. Maybe this changes what kind of data I want or how I want to model something. And then that changes what I, then thing looks interesting, which then makes me do more research, and that sort of spins around. And then in addition to research decision, I also use it to make my investment decisions. So there'll be a company that I don't like as much anymore, or another one that I like more. And ultimately, the companies that I've invested in that are the worst are always at risk of being replaced by the best companies I've not just invested in. And sometimes, I have a great company, but I love it even more and I want to have even more in it. And when you add up those investment decisions, then you get to my portfolio. And my largest investments are now in TSMC, Micron, and Nvidia. And you can always see exactly what percentage I have invested in different assets in the eToro app or on the eToro website. If we compare my investment allocation with the United States, we can see that in the US, there's economic activity across many different industries and good investment opportunities across many different industries. And in my portfolio, I'm slightly more invested in tech, in energy, in semiconductors, in metals and mining, and financial services. If we compare my portfolio with the world, I'm slightly more invested in North America and in Europe, and less in Asia and the rest of the world. Then that was my initial presentation, and now I'll go through the many questions that I've received. So firstly, how are you positioning for the commodity bull run that there seem to be general consensus about? So you sort of one thing is what people are saying and what is a lot on the news, and another thing is what is actually people's opinion. And people's actual opinion is what you should be seeing in the prices, because that's where people's actions are. So you might be hearing a lot about commodity bull run, but that probably is just a reflection of commodity prices having gone up. It doesn't really tell you anything about whether they'll continue to go up. If you look at futures prices, so what you would pay in the future, if you want to sign a contract today that you can receive a barrel of oil in the far future and pay for it in the far future, then you can sign that and lock in a price today. And if you look at those prices for many commodities, the prices will be lower in the future. So there is not a consensus view that there will be a bull run. There is a consensus view that that commodity prices will go down. But for some commodities, I think it's likely to go up more than anticipated, and those I have big positions in. I generally have it in the way that I have the producers, not just the commodities themselves. So I like having companies that produce natural gas rather than just having natural gas futures or an ETF where you pay a recurring fee to have a series of futures in natural gas. And the same goes for gold and for copper and other commodities that I think are very important for the future and where demand will far exceed supply. What is your opinion on the big cycle theory by Ray Dalio? So I think he's done some great work analyzing what factors in history have really driven the rise and fall of big empires. And one he's identified as very interesting is the debt level of the empire, and saying that can be a way for the empire to lose its power, and that maybe that's some of those things that happened in history are now happening to America, and that's worth taking note of and seeing if we can find some ways to solve it. But it's not, in that sense, I would say, a complete prophecy. We are talking about here something where it's some very big factors that have done these things historically without taking account for all the things that are really different today. And so it's an important analysis. It's worth taking into mind, but it's not sort of I think my base case is not that America will lose its power. How is the US behavior towards allies increasing investment risk? So there are certainly many risk scenarios that me and many other good investors have had to run through that probably 10 years ago you would not have spent much time, if any time, on, because you would not have expected many former presidents to do such things. But Donald Trump might, and that makes for some extra scenarios you have to analyze. But then there's also an important factor of whether we are talking about risks that you cannot really do much about as an investor, or risks where you can do something. So when there's a risk that energy prices will be much higher, well, that's a big risk. What if energy prices are a lot higher? Well, you are free to own a lot of energy producing assets, whether that means putting a solar panel on your roof or owning a lot of energy producing assets through the stock market. You can own a lot of energy producing assets, and then you don't worry too much about the energy price going higher. In fact, now that would be a good thing for you. So if it's a risk that you can deal with in that way, then it's not something to worry about. It's something to adjust for. And in the same way with a lot of, Donald Trump has made me a lot of money through his 2 terms. I've had a lot of companies where he's done a lot to help in that way. And so if you just have the right assets, that he's more likely to help than while it's risky. It's like it's risky in a grander sense, but it might actually be good for your money. How do you evaluate the risk that the US starts taxing foreign investors more? So this is a risk in many different countries, and the US is not one of the countries where the risk is higher relative to many others. But tax rates are very important for individual investors. And if Trump, for instance, was to say we're canceling a double taxation agreement with another country, then that would hurt investors both in the US because of the response as well as foreigners. But generally, Donald Trump has done more the opposite. He's done a lot of work to try to say, come and invest in America. I want more foreign investment in America, and I want more Americans to keep their capital in America. So it's certainly something to consider and weigh and value, and it's not such a big risk that it will that this ultimately make you like America less than Europe. Are we heading into a crisis similar to 2008? So again, that's not the base case in the short term or medium term or even the long term, but through history, we've had many big financial crises. And in the future, most likely, we will have more big financial crises. When will they come? Nobody knows. It doesn't just require that something bad happens in the economy. It has to happen, and also governments have to respond wrongly, and central banks have to respond wrongly, and then people have to panic over it. All that has to sort of come together, which means that even when something bad happens, like the most likely scenario is not that a crisis comes from it. So if you constantly are in this situation, which is like, oh, now I'm feeling good and I'm investing in everything, and oh, now I'm all in cash because I'm worried about a crisis, and now they like, most likely you won't be correctly positioned for the upturns or downturns, and you'll just overall have lower returns. And even if you sort of, if you invest in the stock market now, on average your returns are probably high, but at some point there'll be a crisis. If you'd invested right before the great financial crisis of 08, you would have immediately lost more than 50%. But today you would have still more than tripled your investment. So sort of in a longer span time horizon, when you zoom in on the market, it can look a lot like, going up and down and up and down. But when you zoom out a lot, those ups and downs kind of disappear in the grand story. And it is mostly just a line that goes up. So like, a guy climbing a mountain while throwing a yo-yo up and down. Like the what do you call it? The altitude of the yo-yo is like going up and down, but overall it's going up. How would stagflation impact the portfolio? So it depends on what would be the cause of stagflation. Stagflation is what we had in the 70s, where we had high inflation and very low growth. And if you are investing primarily in bonds, that can be quite terrible because, or if you have all your money in cash, because the high inflation really eats into it. If you have companies that are already profitable and they're not growing, they're still profitable. Some companies that would, need to invest a lot for a long time to be profitable a lot further down the line, they would be a little bit in trouble. But then depending on exactly what's causing the stagflation, some companies could do quite well. If, for instance, the stagflation as it was in the 70s was caused by very high energy prices, then the energy companies could do okay in stagflation. So overall, I think my portfolio would do better than most other portfolios in a stagflationary scenario. Any feedback on the statement from the Bank of England that stock markets are too high? So it's not the first time someone from a major central bank have said they think stocks are too high, and then in this case the stocks have gone up since then. And I don't know if there's been a sort of an apology for coming with the statement or something, but yeah, I don't see why central bankers have this desire to be a little bit more prophetic that they can be. Like it's not a very good, not a very bright statement, I think. It doesn't even really make any sense, because it's like, compared to what, you can't just say that the stock market's too high. Are you then saying that the bonds are underpriced, or what is then the thing you want everybody to be holding instead? It's yeah. How sustainable is the current positive momentum? So the many companies now that have quite good levels of profitability, and they have quite good prospects for growth, the global economy is looking quite fine, although there are some challenges that need to be dealt with, and many companies have to prepare their supply chains in case there are some negative developments in the relation between China and US, which has gone from good to bad, but could go to worse. And you know, AI is really the big driving force for making us able to produce a lot more products and services for cheaper in the long term. When you add up those different factors, I think it's looking quite positive. But you don't buy stocks just because you are saying like, I think the future will be good, so I buy stocks. It's like the world can be there can be very good and very bad scenarios. It's in all of those together that you make a portfolio for. You make a portfolio for multiple potential futures, not just for what you think is the most likely future. It's more likely than not that the that stocks will continue to go more up than down, and if nothing else, just because they keep printing money. And but companies also, in general, make money, and so they're good to have. Are you worried about your investment in Taiwan's semiconductor manufacturing company, given the risk of a Chinese invasion of Taiwan? So it's definitely one of the sort of groups of scenarios that I've spent a lot of time on. There are other variants of it, like a blockade of Taiwan, or is other ways of disrupting trade with Taiwan. And I think there's also just a whole different subject of just China competing more with Taiwan, building up a much stronger semiconductor industry in China to compete with TSMC. There are many things to worry about that way, but it's a risk that I'm willing to take given the overall conditions, because they're very, very profitable, and the stock doesn't cost much. So if this happens, yeah, that sucks. But if it doesn't happen, on the other hand, it's extremely good. And so as long as you don't make that, a too big part of your portfolio, it's a sensible, good risk to take. And you have to find those risks that are good to take. It's a risk. That doesn't mean that, that's not guaranteed that it'll work out well, or it will work out poorly. But if you just keep taking those risks where the odds seem in your favor, then over time, you'll lose on some, you'll win on some, and when you add it up, it'll be a good overall thing that you took on those risks. Whereas, if you pay a lot of money in insurance fees and a lot of premiums and try to do everything to avoid the risks, then yeah, every given quarter you maybe made a little bit, or you didn't lose too much. But when you add it all up over the long period, then you probably lost out on a lot of returns from having been more risk willing on each individual trade along the way. And you can really risk. It doesn't really matter with risk for the individual stock. What matters is risk for the whole portfolio. And you can add up many stocks that have some very crazy risks individually, but when taken together, if those risks aren't too related to each other, then actually the portfolio risk can be quite low. How is geopolitics and energy volatility impacting bond yields? So if you have high inflation from higher energy prices, then that higher inflation causes investors to demand higher compensation in interest rate on bonds and other fixed income instruments. And so you see yields go up. And you also, you see people sell off their bonds as well, because they're no longer as attractive, because they'll be hollowed more out by the inflation. If you have negative geopolitical developments, like a further deterioration of the relation between China and the US, or between China and Europe and so forth, and there's less trade, then that can impact a lot of cross-border flows, where you are sort of, if you can have a bias towards home more, and you can have some situations where, if there is a lot of fear quickly, some bonds can seem safer than stocks, and so you have a flow from stocks into bonds that then causes yields to lower. And so there can be some factors that sort of go away, but there's sort of, so geopolitics and energy can kind of impact it slightly differently. And then there's some overlap where you, for instance, with energy, you can have a divergence of prices, where you suddenly see, okay, some countries that produce their own energy, they are doing very well, but others are doing very poorly, and then that also impacts how much you would like to have that country's bonds potentially. How do you evaluate Vistra Corp and Constellation Energy Corp after the ratepayer protection pledge? So I like these companies a lot. The ratepayer protection pledge is a one-pager signed by Trump and 7 of the large hyperscalers, the companies that are investing a lot in data centers. And it doesn't have too many details, but it says that, when you build new data centers, you'll also invest in energy, so that which makes good sense. You shouldn't be building a lot of data centers with no thought about how you're going to power them in the future. So it makes good sense that when you're building data centers, you also invest in more energy, ensuring that we have the energy that we need, and companies like Vistra and Constellation can then make more money by providing that extra energy rather than just seeing their uh, bottlenecked energy increasing their revenues just through higher prices. And I think that's the way to win for America, for the big energy companies, and for the big tech companies and consumers. So it's sort of almost a winner across the block. And yeah, I think Vistra and Constellation, they will definitely win from that energy expansion and necessity. What's your opinion on keeping funds in copy trading or buying a house? So both of these are on average sensible. For copy trading, if we're talking about copying me, then that means investing a lot in stocks, and stocks has historically been the best asset class. Property has historically also been good, not as good as stocks, but still good. And the first house you buy is in a special risk category because you need one house to sleep in at least. And so you start off your life basically with 0 houses. And then you need one house. And so when you buy that house, now you have a house and you need a house. So you have hedged your need for a house. And so the first property there's in a special risk category. If you know, don't know how long you'll be staying in a place, then it can not be worth the fees and the search cost and whatnot to buy a house. If you are buying a house just to rent it out, and then it depends on how much work you actually end up putting in to do the full calculation for, because buying a stock can be very fast, but having a property and then renting it out can have a lot of work attached to it. And so you have to also account for that time when you do the sort of comparison of which one is a better way to deploy your capital and your time in this case. Do you have any plans to retire and leave eToro? No, I have no such plans. My plan is to continue on eToro for the far future. So I'm constantly working hard to get further ahead of other investors. Maybe I can continue to be ahead of other investors for 5 years or 10 years. I don't know. Warren Buffett, he was, ahead of the game for until he was 94 years old. Maybe I cannot continue that long. Ultimately, my goal is that to have a higher lifetime return than Warren Buffett delivered in a shorter time span. And so, yeah, I guess we'll take it like a decade at a time. What do you think of the crash of software stocks due to AI improvements? Is it justified, or are they now at attractive prices? Um, I don't think there are any that are at attractive prices, and they're not generally in my portfolio. I think a lot of companies make no money from the software now, and they won't in the future either. They have a big asset of software that took a long time for very smart programmers to build, but now because of how faster we can program with the support of AI, building similar software is just a lot easier, so it can be done faster, cheaper, and so there'll be a lot more competition, and so they won't actually get high profits from what they've created, which is very unfortunate for them. But yeah, it's not at a level where it's not that they have no value. Many of them have good relations with their customers. They are integrated. They have good data. So there can be many things that they have that are good, and where it's not just the specific features they have in their software, but the software itself there has become incredibly easy to build. How do you balance rules-based discipline with discretionary judgment when the macro environment shifts quickly? So in general, I don't really use any hard rules. If a company has something where it's like, oh, this is very unprofitable, be like, well, then we have a rule. We never invest in companies that are very unprofitable. But it's like, what if they're perfect in every other way? What if they're super, super cheap and, they are very unprofitable now, but they'll be profitable in the future? I can't put any hard rule. The only hard rule there is that I want to invest in the companies I evaluate are the most valuable compared to the price in an overall risk-sensitive way. And that rule just stays in place. And that's not superseded ever by any discretionary judgment. And when the macro environment changes very quickly, and generally things change very quickly, that's when all of my previous work to have a big system and a knowledge of many different things and many different scenarios helps me out, because I'm not starting from scratch. When that new big thing happens, I already have a lot of stuff to work with, a lot of frameworks to apply that can help me get to a good analysis in much shorter time than others, and then sort of make sure that my portfolio is safer or gains a higher return than others. What's your opinion on placing part of one's portfolio in tangible collectible items such as paintings, collectible watches, whiskey, etc.? So in general, if it's purely from an investment perspective, the broad category of collected items is not very good compared to, for instance, property and stocks. Some of them have been good for some times, but then others have been very bad for other times. So when you add them up, it's not a great class. Then if you're talking about just consumption, well, that's a normal thing. Do you prefer to buy a pair of shoes or an expensive watch? You can compare that as you would normally when buying products. But for a small part of one's portfolio, there can be some assets where they are not the best investments. And they're maybe not the thing you would buy from a purely consumption perspective. But when you add the investment value and the consumption value together, they're quite okay. And then they can make up a small part of one's wealth. So if you, for instance, have a house that's very safe and secure, you're not going to get robbed, you think, then you can have nice paintings in that house. And if those paintings increase in value and you enjoy looking at them every day, then together that might make them a good deployment of some of your capital. Maybe you won't make as much money as you would have investing, but having that painting there could be better than saying buying some fresh flowers and some stocks. Maybe having the paintings for a small part of one's portfolio makes sense. Similarly, with having a collection of watches or a whiskey collection you're looking at, investing in a lot of paintings that are then stored in a secure vault where you're paying storage fees, or having paying for a whiskey distillery that they will deliver you a barrel of whiskey 30 years from now, and if they don't go bankrupt before then, is while it can be good, I think on average is not a great deployment of capital. How do you balance staying fully invested and holding cash given the ongoing uncertainty? So when there's uncertainty, my move is generally not to be holding cash. I'll try to have a balance of stocks that I think can do well in many scenarios and not do too poorly in many other scenarios. I don't ever think that going fully into cash is the right move. It can be the right move in retrospect, but when you're all in cash or going significantly into cash, you're just setting yourself up for a lower average return and putting yourself at an inflation risk. So usually I can find other assets that I think I can put together in a risk sensible way as the way to protect myself. And I don't generally having a lot of cash and saying, oh, I have a lot of cash waiting for the market to decline. That's generally a way to lose money. The market's going to go up on average and you sit there with your cash losing out to inflation. And then when the market goes down, probably, it went up by more and you've overall lost out. You might get the timing right, but you're more likely to get it wrong. On average, markets go up, not down, and on average they go up, for longer, and they don't decline for that long. So it's uncertainty does not mean you need to go into cash. What is your view on cruise companies, including Royal Caribbean? So I think they are okay. It's now they'll be paying more in fuel prices if there are higher energy prices for longer, but that's not too bad, but it will cut a bit into profit margins. In general, it's not something I would invest in, but I follow them a little bit because they do sort of substitute for some of the hotels that I have. So some people would maybe go on a cruise instead of going to some of the hotels that I've invested in. But yeah, I prefer the hotels over the cruises. What mega trends do you invest in? So I mentioned several earlier in the presentation, but I'll highlight the most important ones are really AI and the deteriorating relation between America and China. That's the two most important things going on in the world. And those are really the centerpieces for how I put my portfolio together. What is your take on AI-driven layoffs? And do you think universal basic income or other countermeasures are coming? So I think that many companies will be able to automate many things with AI, and then they won't need as many employees to be able to deliver the same amount of services or even more services. But that's anticipated. And as that gets more and more anticipated, those stocks go up a lot in value. And then those shareholders get very rich. And then they start, saying, oh, I'm so rich. What should I buy? What should I buy? And then they start, buying things and wanting things. And that actually creates more new, better jobs before the AI-driven layoffs even hit. So you'll have a situation where some people that have some skills that used to be very rare and special are not rare and special anymore. And so they used to be able to command a high salary, but now they have to only get a normal salary. And then there are people that used to have a normal salary, but suddenly they find that they can get an actual better job with a higher salary. And that sort of change in where people are in the social hierarchy because of this change of what skills are valued, that can be quite upsetting, especially to those that are losing some social status from this. The ones that are going from expecting a high salary down to just getting a normal salary. And they will not be happy with UBI either, because UBI, basic income, like they were expecting a high salary and now they have to be like everybody else and get a basic salary. Then will UBI, I think in the long term in most countries, you'll have a mix of universal basic income and universal basic services. So basic services ensures that everybody has sort of a minimum lifestyle level, and then incomes make sure that everybody has a base level of economic freedom. And then if you have an economy that's grown to be incredibly rich, then it won't take too much of a percentage of taxes on the people at large to provide basic incomes and services for everybody. So I think that is UBI and UBS, that they will be some of the things that AI will deliver. Is it better to add a small amount monthly or larger sum every year? So if you have a very large amount of cash earning a low interest rate compared to inflation, then it might be better to have a big part of that invested into stocks immediately. So if you have a lot of money, if you have some money every month, you're spending less than you're making, then it can make sense to add that every month. And for many people, it's somewhere in between. So maybe putting, in the calendar to add funds every 4 months or every 3 months or something becomes a good sort of a big balancing act. It seems there's a growing supply bottleneck on AI compute. What are the best ways to invest in this? So I looked at many of the different parts of the AI supply chain. It evaluated what kind of profit levels they can have in different scenarios for the future, how many competitors will come in there, what the profit margins will be like. And based off of that, and compared to how much money they will make compared to the prices, I've invested in parts of the value chain that I think are the best ones. And then there are other parts that are also good, but I haven't invested in those because I think these other ones are even better. So there'll be some companies that will make a lot of money from AI, and they're not in the portfolio, not because they won't make more money than other companies, but because I'll make a lot more on the right ones within AI. And then, if AI is bottlenecked in some other way, then I'll have, for instance, if it's bottlenecked on energy, then I'll have the energy to save me then. Can you give some insights into the photonics space and outlook? So photonics for telecommunications has been a good stable market for many years, but for AI chips, it's been really a growth story within a growth story. And because it's already been anticipated that there could be a photonics bottleneck, a lot is being invested into preventing that. So I think compared to how much these stocks cost and how much money they are likely to make, they are not the most attractive segment within the AI space. And so while they are better than many other companies, they're not the best ones within the AI space, I think. Do you use content from semi-analysis in your research process? So I generally don't comment on what data sources I use. What is your evaluation process for selling a stock you held for a long time? So in general, I value stocks and compare them with the price and then decide which one I should have. And for all of that, it doesn't matter whether I've had a stock for a long time or don't have it now, or if it's one that's grown a lot or declined a lot. That doesn't really matter. The question is this the right stock for me to have today based off of how much money I think they'll make in the future? And if the answer is yes, then I'll have it today. And if not, then I won't. Now, there's one little change there, which is for a stock that I have a position on that's already in a big level of loss or profit, there can be a tax impact. And so there it can make sense to say that, okay, I will close a position with a high level of profit while also closing one with some losses on it to reduce the capital gains tax that many investors that live in countries that tax capital gains would be paying. And so there can be a small difference. But otherwise, it doesn't really matter whether every day is day zero, and you shouldn't really be emotionally attached to what you already own or give that any special sense of preference. When is it a good time to start copying? So in general, if you have a lot of cash that's earning a low interest rate compared to the inflation, then it can make sense to invest that into some stocks instead. And the longer you wait, the longer you are on average allocated to a lower yielding asset. So if the right asset to have is stocks, then the best time to get started is 10 years ago, and the second best is right now. And my answer to this would always be that now is a good time, because if I thought that now was a bad time, before answering, I would be changing my portfolio. If I was right now about to say, don't copy me now because, the market's about to crash and we should only have cash, I wouldn't be saying that. I would be selling all my stocks, and then I would be only having cash. And then I would be saying, well, now is a good time to copy. I'm only in cash, so you'll only be in cash. And then, when times change and I buy stocks, I'll buy stocks. So at any given time, you're copying me. And then if I do well from here, you do well from here. That was all the questions. Thank you very much, everybody, for watching. And thank you very much to everybody who sent questions. And yeah, let's have a great quarter.